I guess just jump into it. I'm gonna read a disclaimer just because I'm sure we're gonna cover potentially discuss some single name securities. So let me read that, cover our butts, and get things underway. So, alrighty, welcome back to our what was going to be our July book club, which we had to push a week. So it is August. It's the 1st of August. This is our what seventh seventh book club,
Sixth or
sixth.
seventh.
Yeah, so we've been doing several of them year to date. We we may migrate this into Discord for a more intimate kind of community oriented conversation going forward. If you have any feedback around that, please let us know. We're still undecided, but as I just noted, let me get this disclaimer out of the way. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. Cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, so with that mouthful out of the way, we've got our second Howard Marks book of the book club series. We covered his his The Most Important Thing, which is really a collection of a variety of his writings over the decades. He's been at it for coming up on 50 years now, and he's got a lot of wisdom that's been put out there into the investment world over those years. So, Mastering the Market Cycle is one of his newer reads. It was published in late 2018, so it's about 5 years old. He did add an afterword in that was published in late 2020. Uh, and Mastering the Market Cycle, just like the title implies, Mr. Marks views things as occurring very cyclically um, within financial markets. Um, and I think it's a really good read to try and orient oneself within the market that they're operating in. There's what 18 chapters. I don't know that we're going to go through each and every single one per se. From a, I guess, conversation structure, ideally you've read the book, and if you're going to chime in to speak or ask questions, that would be ideal. If you haven't, that's okay though. If you want to ask questions or comment related to the discussion, I would just ask that people be respectful of us keeping on topic and not taking us down a rabbit hole, no pun intended. So, yeah, I guess before we jump into kind of the introduction, or rather, before we jump into the guts of the material, and I will go chapter by chapter to an extent, I think. But the introduction, I only took a few notes down. But before I kind of ask Joe and JP, you guys to maybe react to your big takeaways from the book. And the intro, I think, level sets what the expectation is from the book. Mr. Marks views the understanding of cycles right near the top of the most important things in investing. Of course, the most important thing, the moniker of his other book, I think he's trying to be specific that cycle comprehension and positioning and understanding and all of that is vitally important to trying to achieve investment alpha. He views cycles as something that is a naturally occurring phenomena, and it's driven by human psychology and behavior. There was a funny quote by the famed physicist Dr. Feynman about imagine if electrons had emotions and how much more complicated physics would be in that case. And he kind of rounds out the intro by noting the importance for an investor to learn to recognize cycles, to assess them, to look for the instructions they imply and do what they tell him or her to do or not to do. So I'll pause and I'll go to Joe, you first, before we get into maybe the guts of it. Maybe if you could just summarize, some of your thinking around the book, the key takeaways to you, and then we can hand it off to JP. And if anyone in the audience wants to share their kind of summary thoughts before we get into some of the guts of the material, feel free.
Yeah, I liked it. So far, out of the 7 book clubs we've had, which another thought on transitioning to Discord is we'll be able to screen share and then skim around the book together. So that's kind of nice. But that'll probably be for the next one. But regardless, Mastering the Market Cycle, it seemed to me uh, as a must read for anyone trying to understand like the cyclical nature of the markets. You really learn from Howard's experience, right? He's got a hell of a lot of experience, much more than me, much more than probably anyone in the audience. And just hearing from him, you kind of learn how to not just understand the cycles of the past, but what to look for to tell what cycle we're in and what cycle could be coming in the future, and how to not behave emotionally and actually like understand like the psychology behind the different cycles and make investments based on his real world examples that he provides, which I like that. What else? What else did I write down? Let's see. For me, a lot of the book takeaways was just that psychological and emotional factors, right? That matter. That makes such an investment, especially for a retail investor, someone who's just learning about the markets, is they're probably acting emotionally. They're probably acting when they see a big swing a certain way. They're making a decision based on that, and understanding how to avoid that and resist your emotional factors is the biggest thing.
Good stuff, Joe. JP?
Yeah. So, when I mean, when I read the most important thing, it was to me, it was more interesting and it was like a much easier read. In terms of like technicality, like technical terms, I feel like anybody could really read the important thing and kind of understand what he's teaching you, and he's very like step by step about all of his ideals, like first level thinking, second level thinking, market efficiency, market hypothesis, psychology. So there's a lot of things that aren't so like textbook material per se, although some of them can be. But I felt like it was a much easier read. But then coming into this, you kind of have to understand like how the economy works. You have to have a better understanding of financial instruments and a lot of terms to really understand this book. And it's not something you can just read once and be like, oh yeah, that was a great book. I feel like there you have to really dive into each chapter and like study it as if it's like some sort of textbook, because for me, I don't know about you guys, but it wasn't the easiest read, nor was it something that was easy for me to remember all the topics that were covered. So yeah, I thought it was kind of difficult. But yeah, I mean, it's very informative. Like there are certain things that seem a little bit more intuitive. He does distinguish the difference between like credit cycle, capital cycles. What's the difference between credit and capital, and a lot of different things that a lot of people have it confused. So it does teach you some very valuable things. And yeah, I thought it was good, but I'd have to probably read it like 3 more times or something to really understand what's going on.
There's a lot of material. It's 350 whatever page book, I guess, depending on which version you're looking at. So I'm with you that it's definitely not a good book to start with. It would not be a good book for a novice investor to begin with, but I think it's a good book for where we've kind of progressed in this book club series. I'm looking at, we started with some books that we shouldn't have started with. We started with Margin of Safety by Seth Klarman, which I think is some aspects of it are simple to understand, but there's definitely some more expert elements of it. We, of course, covered Richer, Wiser, Happier, which I think was a very straightforward and easy read with a lot of good insights. We mentioned the most important thing, the little book that still beats the market. We also, of course, covered The Big Short, One Up on Wall Street, and Think Twice. So yeah, we've definitely covered a lot of good, I think, kind of fundamental investment oriented material. This one, I agree with your sentiment, JP. This was my first time reading it, and I think it's one of those that in a couple of years I'm going to I'm gonna need to go back to it and try to really absorb it. Again, I definitely, in line with what Joe was saying, I think it's important to understand and appreciate that Marx makes it pretty clear that this is a lot of this comes from learned and lived experience. And if you're a younger investor who you're in your 20s, maybe you're in your early 30s, and all you've known is the world of the financial markets post great or global financial crisis, that you you simply haven't lived a lot of the other elements of the cycle. You've never been in a late 2008 situation where everyone is terrified and fear is the modus operandi. So he talks about, and he definitely leans on his many decades of experience. And he also makes the point that he's only kind of called cycles a handful of times in his career. I think it was 4 times over those 40 plus years. And it's really only at the extremes that he's kind of willing to go out on a limb and say, yeah, we're at an extreme up in say the case of 1999, or an extreme down in the case of say late 2008. So that's one kind of part that did resonate with me too, is that as much as we like to imagine that we can fully appreciate these things by reading about them, which they'll help for sure, right? Reading about different market history and what markets were like, and what different things transpired decades ago before we were around, I think is helpful and informative. But it is definitely a constraint for those of us who are a little younger. So okay, let me jump into chapter 1 then, which is aptly titled "Why Study Cycles." And Marx notes that, quote, calibrating one's portfolio position is what this book is mostly about. Now, he doesn't really get to that until later in the book, which, again, I think we'll kind of go chapter by chapter. Maybe we exhaust the discussion around the chapters just as a kind of time check. We're about 15 minutes in. My expectation is that we'll conclude the conversation no later than 10 o'clock Eastern, so no later than an hour 45 from now. So I hope that that'll give us the opportunity to let people come up and chime in if they'd like to, or just if they want to listen in. And yeah. So, okay, so why study cycles? And Mark's obviously viewing the importance of calibrating your position around cycles as what the book's mostly about. He made this point and makes this point regularly, that the way to view the future is on a probability distribution basis. No one can know the future with certainty, but they can do their best to gather the information and make educated weightings of the likelihood of different outcomes to happen. He talks about kind of the 3 general areas that he thinks are most useful to spend time in. The, quote, trying to know more than others about what he calls the knowable, which would be the industry, company, and security fundamentals, being disciplined as to the appropriate price to pay for participation in those fundamentals, and understanding the investment environment we're in, and deciding how to strategically position our portfolios for it. So Matt kind of lays an idea of what comes next in the book. I was looking at some of the things I highlighted, copied into my notes from this chapter, that Marx believes that the aggressiveness or defensiveness within one's portfolio positioning should be adjusted over time in response to changes in the state of the investment environment and where a number of elements stand in their cycle. So kind of the logic being, again, not to maybe front run a chapter later, that if you're in a euphoric market where valuations have gotten stretched to extraordinary levels, where there's no fear to be seen, all of kind of the other adjectives and explainers he'll throw out around understanding why you might be at that level of euphoria, then he would say, well, you should probably reduce your risk taking. You should be more defensive in that sort of a situation, which obviously sounds like no duh, but again, being able to kind of perceive the cycle and take note of where one is should allow them to gain some alpha, as opposed to simply being treating their aggressiveness and their overall positioning as consistent no matter where they find themselves in the cycle. So he kind of calls out the average investor in this chapter. He notes that the average investor doesn't fully understand the nature and importance of cycles. The average investor hasn't been around long enough to have lived through many cycles, which we just talked about. The average investor hasn't read financial history and learned the lessons of those past cycles. The average investor sees the environment primarily in terms of isolated events rather than taking note of recurring patterns and the reasons behind them. And most important, the average investor doesn't understand the significance of cycles and what they can tell him about how to act. So that's kind of what I jotted down in chapter 1, guys. Anyone want to add anything?
For me, chapter 1 talked about learning to tell when to take money off the table and increase your overall defensive strategy when odds are against you. Don't take everything out of the market, but learn to know when to take stuff out and how much. Don't really try to predict the market, but rather prepare for the market, like what could happen, not what you think is going to happen, right? So even if you think something's not likely to happen, you should still be prepared for a case scenario where it does happen. So that was the biggest thing for me. Risk is all about uncertainty.
Okay, well, let me move on then to chapter 2, and we'll keep it moving. Just thinking out loud here, we've got, I think, 18 chapters. So if we spend a few minutes on each, that should give us ample time to get through it all. So, okay, the nature of cycles, chapter 2. I obviously am not. There's no screen to share, but it really comes back to the graph that he has, kind of showing the cycle relative to the long-term underlying trend, which if we were to think about an economy, would be like long-term GDP growth potential, for example. And he notes that it's the oscillation of things around the midpoint or secular trend that this book is largely about. So really it's the deviations from that kind of long-term trend to both the upside and the downside that would be when an investor can kind of take heed of where he or she is at in that cycle. And it's certainly easier said than done. But he calls out a few things. He notes the potential for havoc, as he puts it, increases as the movement away from the midpoint increases, which makes sense. You've got to get pretty far from average to reach the extremes of some of these bubbles on the high end and of some of these depressions on the low end. He notes, quote, cycles are inevitable. Also that cycles' clout is heightened by the inability of investors to remember the past. Cycles are self-correcting and are often viewed as less symmetrical than they are. So find that interesting. Let's see what else. He kind of takes note of some questions he often gets asked, which is, quote, what caused the cycle to begin, or are we close to the end of the cycle? In his view, better questions would be, what caused the current upleg in the cycle to begin? Or how far have we gone since the beginning of the upcycle? Or are we close to the end of the down leg? Which again are kind of the different points in that up and down line that he draws to represent the cycles, deviation away from kind of the underlying normal. So it would be to kind of take note of where things stand in relation to that midpoint, if you will. What else was there in page 42? There were some general warning signs. So he says, quote, rather the themes that provide warning signs in every boom bust are the general ones, that excessive optimism is a dangerous thing, risk aversion is an essential ingredient for the market to be safe, overly generous capital markets ultimately lead to unwise financing and thus to danger for participants. And sure, we can, with our benefit of hindsight, look back to a lot of the events of 2021 as embodiments of excessive optimism, lack of risk aversion, a lot of overly generous financial markets, capital markets in the form of the various entities that IPO'd or that participated in de-SPAC transactions. Whether that 2021 was the same peak in the cycle, is irrelevant. It's that those are some of the, I guess, themes and clues. And of course, he repeats throughout the book the lovely line of eager investors that believe, quote, it's different this time, which perhaps we're living in again with the, I guess now all of this news about superconductors and AI. It is certainly different this time to some people. It will always be. And that was kind of the corollary I drew at the end of the chapter. He says, again, the greatest lessons regarding cycles are learned through experience, which Mr. Marks has the benefit of having started as a security analyst over 50 years ago. I do not. I'm not even 35, so that's an inherent disadvantage I have to Mr. Marks. But he does make the point that we usually only see one major cycle per decade, and that given that reality, if you're younger, you inherently you haven't amassed the same experience as someone who's been around the block for a few cycles. So he hopes that this book imparts some of that knowledge to us. So that's the nature of cycles, chapter 2. Any other thoughts, guys?
I like this point that there's never a single starting point or ending point for a cycle. People always wonder, like, oh, does this, Fed statement mark the end of this or mark the beginning of that? And it's never that simple. It's never one simple day or one simple event that shifts tides. It's always more of a extended event.
All right, let's move on then to chapter 3. So the regularity of cycles, kind of in line with what you just said, Joe, there's a few examples Marx shares in this chapter about the fact that he got pushback from Nick Train, a London-based money manager, about the use of the word cycle, because Nick's view was that given its irregularity, for something to be cyclical, it must have regularity, which Marx kind of pushed back on, shares that in the kind of beginning pages of the chapter. But he does kind of note that we as humans do much prefer looking for, cause and effect and causation and regularity. There's the example in chapter 3 about how it became, I guess, understood in the world of high yield bonds that he says, quote, at one point in my experience, a view arose that bonds tend to default around the second anniversary of their issuance, which he's very clear that that's kind of silly. If that were in fact the case, then the market would price that in effectively. But that we humans try to look for precision and regularity and kind of simple rules, and that cycles are not regular and can't be reduced to just reliable decision-making rules. It's a pretty short chapter. That's about all there is to it. I don't know if you guys would add anything to that one.
Nothing really. Just people have a tendency to think that uh, things don't change, but obviously they do, and you got to bet against what people typically think is going to happen, because that's where the money's at.
Okay, let's move on to chapter 4, the economic cycle. So again, this was written in late 2018, and at the end of this chapter, actually, as he was writing the book throughout 2016 and 17 before the publication, he, he ended up making a reference to Brexit. But before I guess jump to the end of the chapter, he talks about how for people obsess around some of the short-term movements, kind of the short-term economic cycle that he refers to as what's the rate of change for growth going to be in any given year. Whereas he makes the point that it's really difficult to know those things. He doesn't think that forecasting is very valuable, but that the changes in the underlying trend will make the biggest difference in our long-term experience. So in the case of the economy, of course, that would be how many people there are. So birth rates, net migrants, and then on the other side of the equation, the rate of gain, if any, in productivity, which obviously there's been a lot of hype around how AI may fundamentally change that. Maybe this time it's different, as the AI advocates would argue. But the underlying trend of economic growth is going to be what drives business results. Like all else equal, if the economy is growing at say 2%, if we assume that's the long run growth rate, that while corporate earnings, of course, could be somewhat disconnected or perhaps even be counter-cyclical in some companies' cases, and to a large extent, they're going to be driven by that underlying trend. And of course, he's very clear in later chapters that while profits are largely beholden to the economic cycle, price, of course, and some idiosyncrasies within companies like their operating and financial leverage can exacerbate movements. But let me not jump to chapter 6. I think the main thing is really that understanding that the underlying long-term trend is the biggest long-term driver. And then, I just enjoyed he makes the point that changes in productivity, like changes in birth rate, take place in modest degrees and gradually, and they require long periods to take effect. And, this is where I'm sure the Sam Altmans of the world would, contend that what they've created is, in fact, this time it's different, and therefore there will be, step function changes in productivity as a byproduct of the, different AI applications that are going to be worldwide imminently in their view. The last point in this chapter that he makes is around kind of the wealth effect. He talks about how people may consume more for a variety of reasons, a lot of emotionally driven reasons, and then kind of he makes a point that the wealth effect is particularly noteworthy where asset owners are unlikely to fund their consumption by selling their stocks or homes, but when their stocks and homes go up in value, they find themselves more apt to spend, and they should recognize that those gains could be ephemeral and are not actually a good reason to alter their spending patterns. But the reality is that it's a psychological contributor to behavior, and it drives short-term economic variation. These significant asset appreciation or depreciation. So it's almost kind of saying that in a coldly rational world, these things wouldn't happen, but we as humans are emotional creatures, and these things happen. And just to round out my thoughts on this chapter, yeah, the last thing was as he was writing the final draft of this chapter on June 23rd, 2016, which was the day that the UK chose to leave the EU, he kind of raises the point that it's the decision may have significant ramifications. Um, and it's just impossible in the moment to know how much or to what extent those knock-on effects will be. So I guess his point would be, this is a big event, but how much should that change your long-term underlying view? And perhaps not as much. But I'll pause there. Joe, JP, thoughts on the economic cycle, chapter 4? Anything I didn't cover that you want to highlight?
Nothing really additional that you didn't state. I like that it pointed out World War II, 2007, was a strong uptrend over that period of time. And like long-term trends persevere.
I guess this is just piggybacking off of some of the things you mentioned, but he mentions that success isn't about being right, but being just being less wrong than others. So it is very difficult to forecast, and there's just no use in like really trying to get it to the T of predicting what's going to happen in the future. So I thought those are the main points, and you covered it.
Okay, let me keep moving. Chapter 5, government involvement with the economic cycle. It's this one I think is really brief. It's a very short chapter. He simply kind of makes the point that there's the monetary side of the equation and the fiscal side of the equation. Quote, the bottom line is that most central bankers have two jobs: to limit inflation and to support employment. And then on the kind of fiscal government side, they have tools concerning taxing and spending that can stimulate their country's economies. But as we are kind of seeing, I guess over the last year or two here, that we've gone away from ever considering the surplus side of the equation. Unfortunately, here in the United States, it's very much just a question of how large the deficit is going to be in terms of stimulating demand. So we have a massive budget deficit right now, which is very stimulative to demand, which is a little in contrary to what the monetary side of the equation is trying to do right now with raising the Fed funds rate again a week or so ago, to try and reduce some of the spending and investment. So just kind of points out the inherent kind of drivers of government into the economic cycle. I don't think there's really much more to say on chapter 5. So I'm going to roll right into chapter 6, the cycle and profits, which I alluded to a little bit in Mark's notes, that, of course, the ups and downs of the economy are very important in determining the rise and fall of corporate profits. More GDP means, all else equal, more consumption, and thus stronger demand for goods and services. So he makes the point in this chapter specifically that when you think about individual companies operating within the economy, that the linkage between economic growth and profit growth is highly imperfect, right? Just because the economic cycle is expanding doesn't mean necessarily that a company's profit are expanding commensurately. He cites the leverage that I mentioned earlier, whether the company has significant operating leverage, i.e. it has a lot of fixed cost, and that its variable cost per widget or per service rendered is rather low. And those companies can live or die from the cycle. If they can have a wonderful boom, and then of course, if the economy contracts, they could have a glorious bust as the operating leverage cuts the other direction. And then the other leverage being financial leverage, which later in the book, of course, he talks about distressed debt investing, which for folks who bear too much financial leverage, they can be a target of that at different points in the cycle. So really that's about all I had for chapter 6, the cycle and profits. And he makes a point about newspapers at the end of the chapter to kind of point out, technology disruption. And I think newspapers, for that moment in time, are a good example to use, right? Newspapers used to be indispensable. Almost everybody bought one daily. Uh, there wasn't really an alternative for a lot of people in terms of seeking to advertise their businesses locally. But with the advent of the internet in the 90s, that certainly disintermediated newspapers, who many of whom are still struggling to maintain their profitability. Uh, a lot of them have obviously, amid COVID, really had to lean in. New York Times, I think, is a good case study of having leaned into the paid model somewhat successfully. But he says, quote, newspapers provide an excellent example of the ability of an idiosyncratic factor to influence a company's sales and profits completely apart from the economic and traditional profit cycle. So I'll pause there. Any other thoughts on the cycle and profits, guys?
Nothing to add.
Okay.
Yeah, I think, yeah, he just mainly talked about the technology aspect, and you covered that with the newspaper, and then the taxi example about how there's the semi-fixed and variable cost that fluctuate, so that, like, just because you have more taxi drivers, it's not gonna change that much more of what's going on in the headquarters. So, like, he also gives the example about distinguishing between variable cost and semi-fixed cost and stuff like that. But yeah, I think you covered most of it.
Okay. All right. So chapter 7, moving right along then. We've got the pendulum of investor psychology, which I thought the statistic he threw out, I'll read off a few things I highlighted in the chapter. So he says, first, swings in emotion slash psychology strongly influence the economic and corporate profit cycles, and they play a very prominent part in causing ups and downs in the investment world, especially in the short run. So he kind of talks about the oscillation in investment markets between euphoria and depression, and celebrating positives versus obsessing over negatives, and being over versus underpriced. And he says this oscillation is one of the most dependable features of the investment world, and investor psychology seems to spend much more time at the extremes than it does at a happy medium. I really liked the kind of example he shared that I truly hadn't known, which was that only from 1970 to 2016, he asked the question, how many years of the 47 years in that window was the annual return on the S&P 500 within 2% of, quote, normal, with 10% being normal. So how many of those 47 years was the annual return on the S&P 500 between 8 and 12%? I would never have guessed that it was only 3 times, which lends credence to his view that the things tend to be less often on the line of median and normal, and find itself more often on the extremes. I mean, mathematically, that clearly seems to be the case based on that example. Um, what else? So he talks about some just emotions here in the pendulum of investor psychology, talking about examples from the .com swing from greed to fear. He also talks about the tendency of investors to swing between credulity, and skepticism. And then of course this is, I think, the first chapter where he kind of makes notes the characteristic of the superior investor, that in his view is mature, rational, analytical, objective, and unemotional. And that's the, I guess, investor archetype we should all shoot for. later in the chapter, he notes the superior investor resists psychological excesses and thus refuses to participate in these swings. The vast majority of the highly superior investors I know are unemotional by nature. In fact, I believe their unemotional nature is one of the great contributors to their success. And he says that's one of his most persistent observations. And when asked about whether people can learn to be unemotional, he says, it's a yes and no. Quote, it's not my point that emotional people can't be good investors, but it will require a great deal of self-awareness and self-restraint. I think inherently, if you're a very, very emotional person and you see prices moving at extreme levels, you're inherently going to have to exercise more self-awareness and self-restraint, as Marx notes. And maybe that type of individual will be better suited to not trying to be an active investor and seek out performance. And maybe they can settle for market returns, knowing that they don't necessarily have the right makeup to be a superior investor. But I'll pause there on pendulum of investor psychology, and if you guys want to chime in on any other thoughts from this chapter.
No, I like Mark's point that the extremes are where the greatest profits are made. In extreme greed and extreme fear. And it reminds me of back in early 2021, kind of had the whole meme stock craze. Things were going absolutely wild. You had Dogecoin reach almost $1, being an absolutely useless shitcoin. So, and people made killing. People made life-changing profits on absolute garbage. So, yeah, I like that.
There were a lot of people that lost lifetimes worth of fortunes as well, speculating throughout 21, 22. I've read, unfortunately, too many sad stories about that too, which we tend to focus, I think, on the positives sometimes of these bubbly moments, and there's obviously the sad reality of what that begets as well.
Totally. When it comes to something like Dogecoin or crypto, though, I'm a little less sympathetic. It's well understood. It's a very speculative thing. Obviously, a market crash and affecting blue chip stocks is very different.
All right. Moving on then. So, chapter 8, the cycle and attitudes toward risk. And Marx, of course, notes that risk aversion is an essential element, as well as the awareness of risk-taking appetite in a cycle. He lays out kind of what a more, I guess, typical view on kind of risk and reward might be, with the upward sloping line, with all the way at the left hand side, your lowest return, lowest risk being stuff like an insured money market fund, going slightly up into maybe a longer dated treasury, and then into high yield bonds, and then into stocks and so on. He makes a few points in this about the cycle and attitudes towards risk that he says the key thing to note is that fluctuations in attitudes toward risk can cause exceptions to the principles described here, that normal upward sloping line. He says sometimes investors become too risk averse, and sometimes they relax their risk aversion and become too risk tolerant. You almost would think of it, and I think he lays it out in the chapter, that that line in a when investors have relaxed their risk aversion and become too risk tolerant, that line will flatten out, and people are taking on a lot more risk for marginally more return. And then on the contrary, when you get an environment where so I guess that example that I just laid out would be, quote, positive events lead to increased optimism, more risk tolerance, lower risk premiums demanded, lower demanded returns on risky assets, which leads to rising prices, which thus leads to more riskiness. And then the contrary, would be true on the other hand. But he does note that, and I bolded and underlined this one, that widespread risk tolerance is the greatest harbinger of subsequent market declines. To kind of bring it to where the market maybe resides at this point in time, trying to think about what is the risk tolerance of the market today. Just go back 12 months ago, and I think it was there was a lot more fear in the market. And now we're back to an environment where you have a lot of these companies trading at some of the richest valuations that they've ever traded at. Some of that I think is predicated on this time it's different with regard to AI and how that may affect their profit pools into the future. You can't go through chapter 8 without going to the Chuck Prince quote on page 129, which is the classic from the June of 2007, right? Right on the eve of the GFC, when the CEO of Citi, Chuck Prince, says, quote, "When the music stops in terms of liquidity, things will be complicated. But as long as the music's playing, you've got to get up and dance. We are still dancing." And Marx notes that in theory, a bank CEO could have declined to join in this folly, but under the realities of the times, anyone who sat out the dance lost market share. They failed to rake in the easy money, and they might have been forced out of their job. I know this is talking about 05 to 07, but this was a similar kind of thing that happened just a few years before in the late 90s in the dot-com bubble, where you had anyone who didn't choose to participate in the game. Tiger Management dissolved itself, one of the best performing value funds of all time, right in March 2020, right near the peak of the bubble, because people were pulling their money because they'd been long their boring value stocks that weren't going to go anywhere and weren't going to be internet babes. But yeah, that end of there's that end of the pendulum, and then there's the other end of the pendulum. He notes where fear overrides everything, and he talks about the kind of experience post Lehman's bankruptcy in 2008. And he says, quote, "During panics, people spend 100% of their time making sure there can be no losses at just the time that they should be worrying instead about missing out on great opportunities." I mean, it's just so simple. You want to be inversing kind of the status quo. If all the headlines are filled with fear, maybe that's a good time to be a buyer. And on the contrary, if everything's euphoric, maybe that's a good time to be reducing your allocations. But of course, it's easier said
This space was downloaded via spacesdown.com. Visit to download your spaces today.
than done. So this chapter there was a lot in it. Hopefully that was a decent summary to an extent of stuff. But Joe, JP, anyone else want to share any thoughts on the cycle and attitudes towards risk?
I like to quote the thing of investing as bearing risk in pursuit of profit. That was one thing I kind of highlighted and took note on. It's totally true, right? Like you're taking that risk, and it's something that doesn't make you feel too safe at all times, right? Risk aversion, main element, keeps markets safe and sane, is another thing he says, and I like that. It's the fact that people aren't willing to take these huge risks is the reason why we have a functioning market, right? It's why out of the money call options expiring on Friday can only be a few pennies, right? It's not something people are willing to do. It's not something people are willing to risk.
Yeah, I think we got our first Buffett quote in this chapter too, kind of talking about the need to adjust the financial actions based on the investor behavior playing out around us. The quote from Buffett, quote, "The less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs." And Marx agrees with that sentiment, that when others fail to worry about risk and fail to apply caution, that's when the desired superior investor must turn more cautious. And then, on the contrary, when everyone's panicking and depressed, that would be, the time that the superior investor should see superior return opportunities. All right, so continuing on then to chapter 9, the credit cycle, which marks, we got actually, I think it was just this past couple of days, the July senior loan officer, yesterday, the July 2023 senior loan officer opinion survey, which kind of speaks to where things are in the credit cycle, which is a perfect corollary to chapter 9, which is titled the credit cycle. And that kind of survey of loan officers, which I'm just pulling up on another screen here so I can make sure I'm not reading the wrong thing, kind of notes that banks are basically tightening standards for commercial and industrial loans really across the spectrum. It's more than 50% of domestic banks are tightening their lending standards. So it does appear that we're in a tightening kind of portion of the credit cycle. But going back to the book, Mark says, quote, "I consider the credit cycle to be of paramount importance and profound influence. Quote, where we stand in the credit cycle is the greatest determinant of whether debt can be refinanced at any given time." This is probably something that if you've been listening in or following along on, different spaces here on Twitter, there's a lot of debt that is going to be coming due in 2024 and 2025 that, depending on what interest rates look like at that point in time, if that debt cannot be refinanced, well, that kind of speaks to the risk that can come about. I'll read a quote. This is from Marx in 2001. "The longer I'm involved in investing, the more impressed I am by the power of the credit cycle. It takes only a small fluctuation in the economy to produce a large fluctuation in the availability of credit, with large impact on asset prices and back on the economy itself." So he says, quote, "It's essential to always bear in mind that the credit window, can go from wide open to slammed shut in just an instant." And the survey data and action since kind of the March bank issues, I think show that. And while the window might not be slammed shut entirely, it certainly appears to be closing, which tells us that we're in a contracting credit part of the cycle, which again, if in Mark's view, capital and credit is an essential ingredient in the productive process, and that it must be available in order for maturing debt to be refinanced, I think that speaks to some prospective risks in the coming year or two, as there's large maturities that need to be refinanced and may not be able to be refinanced on any terms, or let alone on favorable ones. So he notes that the mismatch of long-term assets that can't be easily liquidated and shorter-term liabilities can easily bring on a crisis if the credit cycle turns negative, so that maturing debt can't be refinanced. And it's often the cause of the most spectacular financial meltdowns. I'm not trying to say that's going to happen. And then he also notes that the credit markets give off signals that can have great psychological impact. A closed credit market causes fear to spread, even out of proportion to businesses' negative realities. So just the mere perception that credit has gotten less accessible can, beget larger psychological impacts than just the idea that, well, you might be paying a little bit more for your debt. And he lays out kind of the credit cycle process in detail. I'm not going to go through all of that, but he does note, right, that again, the credit cycle goes through highs and lows. You might be in a heated part of the credit cycle where the most willing lender may accept a structure with few, if any, covenants and bear more risk because it's a more risk-taking environment. On the contrary, that's you might not get any willingness to lend. But he does note that all else equal, The bigger the credit boom and the greater the excesses of the capital markets in the upward direction, the greater the bust. And let me go to later in this chapter. I made a note to read one other thing aloud. Superior investing doesn't come from buying high quality assets, but from buying when the deal is good, the price is low, the potential return is substantial, and the risk is limited. These conditions are much more the case when the credit markets are in the less euphoric, more stringent part of their cycle. The slammed shut phase of the credit cycle probably does more to make bargains available than any other single factor. I'll pause there, and if anyone wants to chime in on the credit cycle, please go ahead.
Honestly, this lesson here took me to Playboy a little bit, right? A lot of people talking about, oh, the company's shit, look at the balance sheet, this is like not worth anything. It's been some of the sentiment I've heard about the since we put out the report, but right, it's not all about that. We're not saying the company should be worth, $30-$40 a share right now. We're saying that it's cheaper than it is worth, at least by a percentage, right? So you don't make money buying the highest quality of assets, but buying when the deal is good, the price is low, and the potential reward is substantial, right? And the risk is limited. That was the takeaway for me. So that lines up with the Playboy thesis that I see. And maybe, Rod, you can add on that.
Yeah, no, not much to add there. But let's keep on moving then. It's 9 o'clock, so we're more than halfway through the chapters. I think we can get through and then kind of open it up in the next maybe 30 minutes here. So let me keep on trudging along. The next chapter is a logical extension of the credit cycle. It's the distressed debt cycle, and Marx and Oaktree are kind of, I guess, the creators of distressed debt investing in some sense. They've been doing it since the 80s when junk bonds came into the foray, and they've been experts in kind of distressed debt investing for a long time. In the distressed debt cycle, he kind of leads into the chapter of when credit markets heat up, there are unwise extensions of credit, and they call it stacking the logs in the fireplace for the next bonfire, where poor lending decisions are made that provide the fuel for the distressed debt cycle investors once things get smoldering. So he talks about what distressed debt investors are trying to do, trying to figure out what bankrupt companies are worth or will be worth. One kind of interesting side note is you've got a company in the market today, Yellow Corp, which is, one of the largest less than truckload carriers, who has a big debt burden, who is about to file for some sort of a bankruptcy restructuring. There was news out of Bloomberg that Apollo owns most of its debt and is going to provide debtor in possession financing as they run through kind of a liquidation. And this is an interesting, I'm not recommending it in any capacity, long or short now, but what I kind of saw it today. I've been watching it, and I've seen over the last few days now the common equity, which would not be what Marx is talking about when he's talking about distressed debt investing. He'd be talking about buying up, the paper that would allow him or his entity to get control potentially on the other side of the bankruptcy process. But in the case of Yellow, what's going on is that they have a lot of assets on their books held at very low historical valuations. So stuff like land, stuff like terminal facilities that they might have bought decades ago, that you're not going to mark up the land or the value of a terminal on your balance sheet. But I saw that a hedge fund out of Boston had, as of today, gotten to 42% of common stock ownership of Yellow. And I spoke with another investor today kind of like what's the logic here, and he'd been looking at some of those terminal assets as well as the tractors and trucks that they're going to be selling off. And his conclusion, and clearly the conclusion of that hedge fund, was that in the liquidation, the assets will be worth far more than what they are held on the books for. And the implication, with the equity now trading over $200 million market cap today, is that they'll be able to pay the creditors off in full prospectively, and that equity would actually see a recovery. Now, I have no clue what's going to happen. I just thought that was an interesting corollary to this chapter that's kind of going on in markets now. So again, who knows if yellow common stock will see any recovery on the other side of this. But to bring us back to the distressed debt cycle, though, distressed debt opportunities are highly cyclical and determined by developments in other cycles. So usually you're not going to get to the good, I guess, if you're Oaktree and you're looking for distressed debt opportunities, you're not going to get to this until other things have happened. Maybe you've already had a very severe credit tightening cycle. The economic cycle perhaps is turned down and is in a recession. Corporate profits are declining, and that window to access credit has been shut off. So lots of defaults, which there's obviously been a big uptick in bankruptcies in 2023 already. So I thought this chapter was interesting. Even after, and he says, quote, even after the fuel for the bonfire has been assembled, there won't be a conflagration until the second ingredient arrives, which would be an igniter in the form of that recession, leading to corporate profit declines, leading potentially to that credit crunch. So, the distressed debt cycle for him and his firm, they say, they've seen the cycle in action repeatedly. My 29 years of experience in distressed debt tells me its themes definitely do rhyme. And, in his view, you can get wonderful returns from the distressed debt cycle, if you're able to be a prudent investor who observes where things are in the cycle. And he says, quote, hopefully it's clear that multiple underlying cycles have effects on the distressed debt market that are far from discrete and isolated. The result is a dramatic cycle in distressed debt opportunities, and one that is subject to explanation. Okay. So any other thoughts on distressed debt cycle chapter? Okay. We're almost there. Chapter 11, the real estate cycle. So this one, I won't spend too much time on it. He kind of talks about how in the case of the real estate cycle, it's inherently constrained by long lead times for real estate development. And there's people at various stages in the development process, and this is not a market where one player is often going to be able to control the market they play in. He talks about the example of the developer who might have dreamed of high returns, but then gets stuck with their construction loans going bad, and kind of talks about the downside of the real estate cycle. It was interesting, it's page 184, at least on my version, the graphic that he shows in I guess it was 2012 or 2010. Sorry, he was at the 2012 Oaktree conference when one of his partners showed him a graph kind of showing that the housing starts per million had dropped to kind of extraordinarily low levels, far lower than anything seen post World War II. And the takeaway there was that while on its face, maybe in 2011 and 2012 everyone thought it was a terrible time to be investing in real estate, that was actually the best time. The underlying fundamental math kind of proved it to be the case, and that was the time to be a buyer when it was out of yeah. So he says, quote, the proper course seems clear now when we look back on the evidence. The reasons behind successful decisions invariably are obvious in hindsight. But in this case, dispassionate analysis of cyclical data permitted the right decision to be reached in real time, which is when it counts. I was very lucky. I bought a house in early 2013, which unfortunately I had to sell in 2016. But I definitely remember, and going back and looking now, I wish I'd bought maybe if I had the money, I would have loved to have bought more property, but such is life. Um, let's see. I also kind of really bolded one other section of this chapter, which definitely is is an important thing for me to remember. He says, quote, "In short, conscientious belief in the inevitability of cycles like I'm urging means that a number of words and phrases must be excluded from the intelligent investor's vocabulary. These include never, always, forever, can't, won't, will, and has to." If there's anything the last couple of years have taught me is that never, can't, uh, and always and all that stuff, we need to really try to disregard them. Extreme tail outcomes seem to be more normal than ever. And yeah, that was just one other takeaway from the real estate cycle chapter I had. Any other thoughts on the real estate cycle? All right, so chapter 12 then is putting it all together, the market cycle. So this kind of ties in a lot of what Mark's just laid out in the preceding chapters about the various different cycles. So I think the summary opening of this chapter is really good, where he says, quote, "The first time an inexperienced investor lives through an upward market cycle, the beginnings of the progression may seem logical as the positives compound in a bull market or bubble. The fact that so much good news and good feeling can end in losses can come as a surprise. It is inescapable that it will seem so to the uninitiated, of course, because if the progressions weren't permitted to go on to extremes on the basis of errors in judgment, markets wouldn't reach bull market tops to collapse from, or bear market bottoms to recover from." And obviously it seems obvious, but I think it goes back to kind of his point earlier on that not reading up on your history and having not lived it before, it's very easy for inexperienced investors to maybe get lured into bad decision making. So there's a quote from Buffett in this chapter I wanted to note. So we've got a very succinct one with regard to the market cycle. What the wise man does in the beginning, the fool does in the end. And Marx notes that in his view, that tells you 80% of what you need to know about the market cycles and their impact. He even said it more concisely than that. First the innovator, then the imitator, then the idiot. I don't know where we are right now. Are we the idiots? Or are we at the imitators yet? Not sure. But he definitely drew some corollaries to stuff that's going on in the market today. On page 201, he notes most investors do capitulate eventually. They simply run out of the resolve needed to hold out. Mike Wilson at Morgan Stanley has recently marked up his broader market calls and is now expecting prices to keep going up. Piper Sandler's Michael Kantrowitz, I think it was Michael Kantrowitz, meaningfully marked up his expectations on S&P. He'd been a big bear, and now a lot of these big bears are throwing in the towel, and they've capitulated. So when I see market prognosticators doing that, it makes me wonder if perhaps we're about at the end here. Not saying that we are or not, but just a couple things I've noticed recently in terms of this chapter here about the broader market cycle. And look, it's really freaking hard not to fall victim to capitulation. He inserts the story about Isaac Newton, which I'm sure people might have heard before, and if you read the book, that Newton bought back into the South Sea bubble, near the high, ended up losing tens of thousands of pounds, which was obviously a lot of money in 1720, and makes note that not even one of the world's smartest men was immune to this tangible lesson in gravity. And there's some more examples about kind of the dot-com bubble. I won't read through all of them, but in the reverse of the top that results from the upswing of the market cycle, we see that the nadir of psychology, a total inability to access credit, minimum price, maximum possible return, and minimum risk all coincide at the bottom when the last optimist throws in the towel. So we obviously haven't had that in a very long time. You've got to go back to 2008 early 2009, I think, for that sort of a trough environment where you've got everyone giving up and everyone in fear. But chapter 12, I think, really articulates the ways in which these market cycles all come together. So I'll pause there and welcome any thoughts on chapter 12. All right, I'll keep on moving then. So chapter 13, how to cope with market cycles. Let's see, first note I kind of wrote down for this chapter is, quote, the risk in investing doesn't come primarily from the economy. It comes from the behavior of the market participants. Of course, our wonderful, it's not what you buy, it's what you pay for it. He says, in the absence of the ability to see the future, how can we position our portfolios for what lies ahead? Marx thinks much of the answer lies in understanding where the market stands in its cycle and what that implies for its future movements. Quote, we may never know where we're going, but we better have a good idea where we are. So he certainly is a believer in cyclicality and the tendency of history to rhyme and repeat itself, if not one for one, but with a lot of similarities. And let's see here. Before I get to page 220, which has a lot of good discussion points and talk about for a minute, there's another good Buffett quote in this chapter where Buffett says, quote, the less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. When others are euphoric, we should be terrified. When others are terrified, we should turn aggressive. Obviously, a lot easier said than done. I think I've noted that a lot of the indicators of late, depending on which kind of surveys you're looking at, show we are back to a lot of euphoria, which means, at least it scares me. But he basically says to understand where we stand in the cycle depends on two forms of assessment. The first is quantitative, gauging valuations. He says this is an appropriate starting point, for if valuations aren't out of line with history, the market cycle is unlikely to be highly extended in either direction. You'll see people point out things like the forward earnings yield, or rather the forward price to earnings ratio of, say, the S&P 500, which people will look and say, oh, if you look at a 5-year average, it's only a little bit higher than average. But then when you look at maybe a 20-year average, you can see it's far higher than normal. And that also doesn't consider interest rates or where we are in the economic cycle, which Robert Shiller's cyclically adjusted price to earnings show. And Shiller's CAPE shows us really more extreme than just about any other point in history, but for the dot-com bubble, as well as the kind of COVID bubble in 2021. So not a good indicator for the quantitative starting point. Valuations are very rich broadly. And then he says the second is essentially qualitative, awareness of what's going on around us, and in particular of investor behavior. So when I think about some of these companies that have filed for bankruptcy year to date, many of whom are essentially worthless, and seen how egregiously they've run up in value after their bankruptcy filings, that's just one example of, I think, the type of euphoric investor behavior that we're still perhaps experiencing. So I guess that answers where I think we are in the cycle. But one other point on chapter 13 before I talk kind of through, and I guess I'm not going to really talk through it. Page 220 has his, and it's in the most important thing that we already went over a few months back, if you participated in that discussion, where it's like, how are people characterizing the economy, the outlook? How are lenders acting? How are capital markets acting? And there's, is it vibrant or is it sluggish? Is it positive or negative? And, kind of how your answers to those questions come in. Are yield spreads narrow or wide, right? A lot of these answers tell me, that it's still, as he says, for that guide, if you find that most of your check marks are in the left-hand column, which I think they are, hold on to your wallet. But last thought before I pause on chapter 13, he's very clear that if you think that something is mispriced, you shouldn't wait for the bottom. You should conduct your analysis, have a view on the intrinsic value of that which you're going to be buying. And he talks about the distressed debt that Oaktree began accumulating after Lehman's bankruptcy filing in late 2008. And he notes that, quote, we continued buying through year end as prices went lower and lower. By the first quarter of 2009, other investors had collected themselves, caught on to the values that were available, and gathered some capital for investment. But with the motivated sellers done selling and buying having begun, it was too late for them to buy in size without pushing up prices. Now, obviously, if you're not managing billions like Oaktree, perhaps you're less concerned about pushing up prices, but it's kind of a statement of fact that the bottom can only be recognized after it's passed. And if you find something is an attractive buy, you shouldn't just say, yeah, I don't like the stock chart. I don't want to be the guy who catches a knife, because by the time the bottom is in, you may very well have missed that opportunity. So I'll pause there on how to cope with market cycles, chapter 13. See some other folks have come in. Again, if anybody wants to chime in, feel free to request to speak. We're walking through Howard Marks' Mastering the Market Cycle. We're going to wrap this in about 40 minutes. We've got 5 more chapters to kind of get through. Happy to hear folks, if they want to ask any questions or chime in, feel free. Joe, JP, any other thoughts on chapter 13 that I might have overlooked?
One note I wrote down was that if valuations aren't out of line with history, then the market cycle is unlikely to be highly extended in either direction.
There was one other thing I highlighted. I did it in red because it's bad. It was on page 246, where he says, it's important to note that exiting the market after a decline and thus failing to participate in a cyclical rebound is truly the cardinal sin in investing. Experiencing a mark-to-market loss in the downward phase of a cycle isn't fatal in and of itself, as long as you hold through the beneficial upward part as well. It's converting that downward fluctuation into a permanent loss by selling out at the bottom. It's really terrible. So again, we all, when things are calm, I think like to think that we can make the right decisions and not act on emotions, but it's just vitally important to have the emotional wherewithal to live through and not sell at the lows. And sadly, I still to this day hear stories of people who sold during the financial crisis and literally stayed in cash for 15 years. Terrifying to ponder, but it's happened. So okay. Let's see. Continuing on then to chapter 14, cycle positioning. I think he laid out kind of the 3 pairings and the 6 main components of kind of how to try and optimize your positioning given the underlying cycle. So he does say, quote, the study of cycles is really about how to position your portfolio for the possible outcomes that lie ahead. And he talks about your cycle positioning. So deciding on how you will position your portfolio in response to your judgments regarding the principal cycles. Asset selection, deciding which markets, indices, specific securities to over or underweight. One's aggressiveness or defensiveness then is obviously also important, as well as really appreciating that, yes, just as there's skill involved in the decision-making process, there is certainly luck to both the up and downside. And he notes skill and luck are the prime elements that determine the success of portfolio management decisions. And it doesn't matter how good or bad you are, there's inherently skill and luck involved in that decision making. He has a lot of graphics in this chapter that, for the sake of a verbal discussion, is probably not. I'm not going to try and butcher, but this chapter is definitely one better. This one I think requires a couple read throughs to really appreciate what he's trying to say about optimal cycle positioning. Again, welcome thoughts before I go on to the next chapter, because this one is, I think, a little harder to do without screen sharing.
Nothing to add on this one.
Okay. All right. Chapter 15, limits on coping. Quote, in my opinion, it's entirely reasonable to try to improve long-term investment results by altering positions on the basis of an understanding of the market cycle. But it's essential that you also understand the limitations as well as the skills that are required and how difficult it is. So this is Marx, again, making the point that it's an infrequent thing that you should be doing. He kind of hews around when the cycle, and it's on page 277, he kind of has a graphic of kind of what the fair value range would be in terms of a distance from that underlying intrinsic value. And you can see that there's points at which things are richly valued and points at which things are cheaply valued. His view is that it's hard to make frequent distinctions and hard to do so correctly. Thus, don't make those distinctions when you're in the middle ground. It's not going to be as profitable as at the extreme, and it's going to be a lot harder for you to get it right. If somebody's trying to call, a top or a bottom every single day, it's kind of a silly exercise. It's only really when things get very extreme that you should be, and he's obviously tooting his own horn in this chapter a little bit. He notes that he's made all of 4 or 5 calls in his 5 decades in markets, and he says, quote, by making my calls only at the greatest cyclical extremes, I've maximized my chances of being right. No one, and certainly not I, can succeed regularly other than perhaps at extremes. So don't try to be calling every, I guess, top and bottom as we're trying to understand where we are in the cycle. Is maybe the big takeaway for that chapter. Detecting and exploiting the extremes is the best we can hope for. That's what he says. Any other thoughts on this one?
Just made me feel guilty. I'm always trying to make decisions based on short-term trades rather than like a long-term outlook. You know that, Rod.
Hey, but you've been a long-term holder of your Bitcoin though, Joe, so that's what counts.
Oh, I am. It's the longest of terms. It's going to have to fall quite a bit for me to lose money, Rod. Back down to about $30 per coin.
Goodness, let me not sidetrack us. Shouldn't have said anything. Okay, Ben, let me keep going. So a couple chapters left, and we can see what people want to talk about when we get done with this. So chapter 16, the cycle in success. I think it's an interesting point he makes in this chapter where he says, quote, success isn't good for most people. And I'll share, for me personally, having come off of such a euphoric win in early 21, it definitely didn't position me well for trying to make good investment decisions on the back of that in what was clearly a very ebullient and bubbly time in financial markets. Another kind of quote of his that I lifted here is that in investing, there's a complex relationship between humility and confidence, since the greatest bargains are usually found among things that are undiscovered or disrespected. To be successful, an investor has to have enough confidence in his or her judgment to adopt what David Swensen, the head of Yale's endowment, describes as, quote, uncomfortably idiosyncratic portfolios which frequently appear downright imprudent in the eyes of conventional wisdom. That definitely speaks to me because I find myself drawn to the things that are undiscovered and disrespected. I certainly feel uncomfortable, actually, when my investments are viewed prudently by the conventional wisdom. I am not an investor in mega cap technology stocks, perhaps to my own stupidity. But that part really spoke to me because that's just how I kind of exist and think about markets personally. And then later in the chapter, he kind of talks about the famous Death of Equities magazine cover that happened right around the bottom in what was it, the 70s, 80s, losing track. But, one other quote from this chapter before I shut up. Quote, good times can encourage investment decisions that depend on the perpetuation of such good times in order to succeed. And that certainly reminds me of 2021. Any other thoughts on the cycle and success from anyone?
Yeah, I also like that. Can you hear
Yeah.
me? Is this working? I like the part where he's like, don't get confused with how smart you are based off, this isn't quote unquote, but he talks about how like just because you made money off of the bull market doesn't make you a smart person. And I thought that was a funny comment because I remember like during that bull run, so many people were like, oh my gosh, like I'm so good at investing, and they would be giving everybody advices and talking about how much money they made. But yeah, it's, you can't get confused with the cycle and your success.
Yeah, it's definitely very easy to conflate skill with what was luck, and you need to keep yourself grounded because it is in fact a very long game. If one wants to stay in the game as long as someone like Mr. Marks, you've got to keep yourself even keeled. And it's easier said than done. I mean, I fell victim to it too. I get it in 21. A lot of euphoria. All right, moving on to the penultimate chapter. Excuse me, the future of cycles, chapter 17. He starts with the tendency of people to go to excess will never end, and thus, since those excesses eventually have to correct, neither will the occurrence of cycles. Economies and markets have never moved in a straight line in the past, and neither will they do so in the future. And that means investors with the ability to understand cycles will find opportunities for profit, which I think is a pretty nice, succinct lead-in. I'm looking at my notes from this, and I really didn't jot too much down. I lifted a quote from the first part of this chapter, where he lifts quotes from a variety of respected business leaders from 1928 and early 29, where they say things like, there will be no interruption of our present prosperity. We are only at the beginning of a period that will go down in history as the golden age. The fundamental business of the country is on a sound and prosperous basis. And just how wrong those individuals who were presidents of businesses and, in fact, the United States, for that last quote, were on the just as a prelude to the Great Depression. So, we got he talks about kind of in the 2000s the expectation of permanent prosperity rearing its head again, and then what it goes back to, which I think this whole book from Marx is really about, for mastering the market cycle, is understanding that people are part of the market. And he says, quote, the reason for this, as I've harped on repeatedly, is the involvement of people. People's decisions have great influence on economic, business, and market cycles. In fact, economies, business, and markets consist of nothing but transactions between people, and people don't make their decisions scientifically. That goes back to my joke earlier that he lifted from Professor Feynman about imagine how much harder physics would be if electrons had feelings. Clearly, we're always going to have humans in markets, unless perhaps AI eliminates all of us, and who knows what their markets are going to look like. But he does note that, quote, cycles will never stop occurring if there was such a thing as a completely efficient market, and if people really made decisions in a calculating and unemotional manner, perhaps cycles, or at least their extremes, would be banished, but that'll never be the case. Now, he said never say never earlier, so I don't know, but I am inclined to believe that cyclicality is likely to be it's part of the human condition. It's driven by our existence as emotional beings. So I don't have anything else for the future of cycles. In essence, he's saying that because we are human, they will continue. I don't really have a rebuttal to that. All right. 934, last chapter, the essence of cycles. So he has an afterword, but I'm going to kind of skip that. One thing he does point out in the afterword is that the pandemic was not a cycle. I think is the kind of takeaway for that one. He says, I'll skip 18 for a second. I'm convinced cycles will continue to occur over time, highlighted by excessive movements away from normal and toward extremes, both high and low, that are later followed by corrections back toward normalcy and through it to excesses in the opposite direction. But that's not to say that every event in the economy or markets is cyclical. The pandemic is not. So going back to 18 as we wrap here, it's really a summary of the thoughts he put out throughout the book. So chapter 18, I think, is a distillation of kind of the book's earlier paragraphs. He pulls them together. So yeah, I'm going to kind of skip that. And yeah, I guess with that said, Ben, that is our kind of discussion on Howard Marks mastering the market cycle. Now that we've kind of gone through the chapters of the book, and obviously we started off with sharing some kind of summary thoughts from the Wook folks here. Would welcome anyone who's been listening in. If you'd like to chime in, please feel free to request to speak. And to the extent that we keep the conversation going, I'll happy to keep this open for another half hour. I'll pause there. Joe, JP, if you want to chime in on anything I missed, while we wait and see if anyone wants to come up and chime in. I can't really hear you, Joe, if you're speaking.
Can you hear me? Sorry, I think I was covering my microphone.
Yep.
I'll just say thanks for hosting it so well, Rod. You really do just demonstrate great knowledge on the books every month. And if anyone wants to tune in to the next month's club, we have the schedule on @Wook Capital shared on the Twitter account, and I'll pin it in the nest here too.
Yeah, so we've got Mastering the Market Cycle that we just covered. So this was our second Howard Marks. We will have our first Taleb book, so August's book, even though we're in August, but the last Tuesday in August we'll do Fooled by Randomness, which should be a very good one. We've got, after that, 3 more to round out the year, which there's I guess we're still waiting, Joe, on when Mr. Popper's The Degenerate Generation comes out to potentially shift our calendar around. But the final 4 books for the year will be Fooled by Randomness, The Warren Buffett Way, The Little Book That Builds Wealth, and then The Degenerate Generation. So we've covered Klarman's Margin of Safety, Morgan Housel's The Psychology of Money, Greenblatt's The Little Book That Still Beats the Market, Mike Lewis's The Big Short, Peter Lynch's One Up on Wall Street, and Michael Mauboussin's Think Twice earlier this year. All of those recordings are available on our YouTube, which is, I think it's @Wook Capital. We'll have this uploaded to the YouTube as well. Obviously, it'll be here on Twitter. I refuse to call it X for as long as this platform allows it. And yeah, if you have any feedback for us, as I mentioned at the beginning, for this sort of discussion, I think it's a little, it's more naturally held, perhaps in a Discord where it's a little more intimate and people can kind of via Discord chat kind of chime in. I think some people might be more comfortable like that. So Joe, maybe we put a poll out asking what people would like for the for Fooled by Randomness, if they prefer that we keep them on Spaces, or if they'd like to kind of have the conversation on Stages and Discord. That'd be good, I think, to maybe get some feedback that way.
Yeah, we'll I think honestly try it out next month on Discord. I think it's a good idea. I like the ability to screen share and the ability to use text chat. Also, I did some looking around last night to see if there's a more updated release date for Nathaniel Popper's GameStop book, and a few websites said different things. I saw one that even referenced 2024. So if it is pushed back, then we're open to suggestions to replace it. Send us over some tweets, send us a direct message on Discord anywhere, and we'll see. But obviously, it's still tentative. We're not sure. Maybe it is coming out this year still. Haven't spoken to him about it.
All right, very good. So for now, tentatively, if you're not a member of the GME DD Discord, then be please feel free to join. That's where we will anticipate hosting for Caleb's Fooled by Randomness. Just kind of as a broader programming notes, we'll be back tomorrow with our Wednesday night open mic that I host. I had been hosting on my personal account. I think we're going to use the due diligence handle, which is still at GMEDD, to host it. I'll co-host it with Joe. So that's Wednesdays at 7 Eastern that we hold those calls typically. We also hold calls on Fridays at the market close from 4 till around 6 Eastern. So all of that is available on our Twitter handles, the replays, and the Wook and reviews. As we were kind of just talking about, I do some screen sharing. So if you want to follow along, just be sure to join the Discord if you want to get more than just audio, if you'd like video as well. Or of course, if you can't join live, those replays, Joe puts them together and uploads them to our YouTube channel if you'd like to catch those, where we just kind of talk about some key headlines and markets and host a kind of a roundtable type discussion on a weekly basis. So, okay, with all that said, appreciate everyone's interest in Wook Capital Management. As you know, hopefully you all know, our view is that kind of through collaboration and crowdsourcing of research, we can in fact achieve investment alpha. And in this world where information travels faster than ever, that's essential to be kind of plugged in and know more than hopefully the market. It's a very difficult thing to do. So we'll continue kind of doing these learning and development type programs. You know, we understand, and just like we are, we're young investors. We have a very long career ahead of ourselves, hopefully, and it's a daily routine trying to learn and get better and flex those muscles, those critical thinking skills, so on and so forth. Investing is hard; it's not easy. So we appreciate everyone tuning in and listening to our review of Howard Marks' Mastering the Market Cycle. That's it for us this month rather, on our book club series. So look forward to talking to you all soon. Cheers, everybody.